All right, hello everyone. Today I'm going to review my Roth IRA. Right now it is up $260 for a 31% gain. The Roth IRA is actually doing better than a Robinhood portfolio in terms of percentage gain. So I really think that this portfolio needs to be generated with more equity. So I'm going to start putting maybe around $200 every check and see where it goes from here. I really need to max this out. I've talked before in previous videos about maxing out the Roth IRA, and like I said, I've been totally ignoring this ever since I put that $1,000 in. I would like to start, managing this portfolio a little bit more. I like how I got the companies into these little pie charts you see here: technology, healthcare, finance, consumer discretionary. I've done all this stuff to really clean the portfolio up, and I really like how it really has cleaned up everything, so I can take a look at stocks within their sectors. But let's quickly review the portfolio. Technology is up big right now, 8%. So we're gonna just quickly look at some of the stocks in here. Nothing was sold. Microsoft looking good, Intel good, IBM 6%, and Activision Blizzard 7%. So pretty good to see that technology portfolio is still rocking it. These are some pretty good blue chip companies. I think Microsoft is just absolutely killing it right now. It's up to around 134. I think my average price is 121, and every stock in the portfolio I think pays a dividend. So technology, like I said, doing very well here. Healthcare, let's take a look at them. Let's just kind of pull it up. Phone's kind of slow today. Abbott Laboratories in the lead, 5%. Actually, it may not even be in the lead. United Healthcare Group up 6%. So this is a pretty good growth company that I was getting ready to start to put them in the Robinhood portfolio because they had dipped like 12% some time back, got all the way down to about 227 or something like that. But yeah, I ended up putting them in the Roth IRA, the M1 Finance portfolio, and it's doing very well. So American company up 5%. It's good to see. And AbbVie, excuse me, I was getting ready to say Abbott Laboratories. This is AbbVie and Abbott. They were once an original company, just one company back in 2013 until they split. But AbbVie up 2%. AbbVie's not really been doing good. There was some nice growth in 2017, I think, but that's not what I'm going to do here. Average price $84. Still just kind of holding this out. It kept my average price from the last time that I bought the stock, and then I sold the stock, and then I bought the stock again, and then after that, it just kept the average price. So again, I think this application sometimes can get a little bit weird, but if you just bear with it, it's a pretty good app. I like the app a lot. Let's go look at industrials here. Industrials and aerospace is both combined, two sectors that are combined into one pie chart. Caterpillar big, 9%. Very interesting. Take a look at them. 122. Yeah, I definitely thought Caterpillar pretty good buy. I think it got as low as 115. That was when the trade war stuff was going on back in last year in December. But Caterpillar, excellent. It's really good. No dividend yet, but they will pay a dividend. A.O. Smith, you guys know I love companies that produce water and anything that has to do with water. A.O. Smith is right there handling that, and my average cost is $41. I thought that was an excellent steal. I love these buys when it gets really low like that, and price is $45. So this is a good stock to buy and hold around that $40 mark. Boeing looking pretty good, up 7%, and UPS 7%. So I thought about putting UPS into the Robinhood portfolio at one point, but then I remembered that I had them into the Roth IRA, so I didn't do that. Average price is $91. So I definitely got them on a steal. And I sold the stock and I bought back in, and it still kept my average price. So it's really interesting with this M1 Finance app how it does things, but. Utilities and energy up 6% on them. Let's take a look at them, see what's in here. ExxonMobil, Dominion Energy, Shell, and PPL all looking good. Let's take a look at these dividends. Yeah, some companies in this pie chart has paid dividend, and I'm not really sure which one it did, but I love this sector or sectors. Energy and utilities combined, pretty good defensive commodities in there. Take a look at real estate. I don't think real estate is doing all that well. But again, everything is really high right now. LTC Properties up 5%. I just bought them. It's up 5%, so that's interesting to see. Reality Income, this is just a buy and hold forever stock. Get paid a dividend, monthly dividends, might add. Iron Mountain up 7% on them. I've been buying and selling Iron Mountain a lot. It's been in the portfolio, it's been out of portfolio, and it's been back into the Robinhood portfolio, and then after that, Robinhood portfolio, it's out of the Robinhood portfolio now. Now it's back into the Roth IRA. So I'm trying to find a place for Iron Mountain because I definitely like their dividend yield. Not too much growth with this company. It deals with records management, paper records management, which kind of concerns me because everything is like computerized and everything's going to computers. As far as like records management, it's all on PDFs and stuff, and it's being managed on a folder on a laptop or something. So I'm really worried about this paper management thing, but they're trying to get into like data centers and all this sort of stuff, and it's really interesting to see. EPR Properties, I'm down 0.76%, so I just bought them. So take a look at the consumer goods sector. Procter & Gamble, 6%, still looking good. And I'm quite surprised with them because they have been. This stock has really. When I bought it was high. I bought it originally. That's around $77 a couple of years back, and now it's like at 108. So this is not a good buy. But I do like its defensive utilities. General Mills looking pretty good. They were at a really good steal at $37 or so. Colgate, up big on them. Not a good buying point right now. $71 for Colgate. And then Coca-Cola up 4%. So I think a lot of consumer good companies are overvalued. Coca-Cola's overvalued. General Mills overvalued. Well, not. I think General Mills is still it's sort of a good buy. Procter & Gamble is definitely overvalued, and Colgate is getting there. I think around $80 or so. I would probably say that Colgate's overvalued, but right now they're at $71, and I still would not pay $71 for a stock like Colgate in that regard. But there was also something that I wanted to talk about, which was ticker symbol Altria. I failed to talk about them in the Robinhood video. Excuse me. I failed to talk about them in the Robinhood portfolio in last video, and I'm going to definitely talk about Altria, ticker symbol MO, at the end of this video. And I've got some notes as to what happened to that stock and why I ended up selling that stock and why I'm looking to buy back into that stock. But let's hurry up and finish this video. Consumer discretionary. Since Disney is now in the Robinhood portfolio and was removed, it got replaced with Starbucks. I think that's a good trade. Actually, I'm up 1% with Starbucks already, so a very, very good growth company to buy right now, even though at this valuation level, yes, it is overvalued, but the growth aspects for the company, $82 in probably 3 years or so, is going to probably look undervalued and a good buying point for Starbucks. So Target Corporation, good on them. Ford, good, and McDonald's, good. This is a good sort of consumer discretionary that preys on services, retail, kind of like an industrial, cars and stuff. It's pretty good. I like this little diversification in the portfolio. And then the last pie here is finance. Visa is up pretty good. Morgan Stanley I thought was undervalued, and I bought them. It was around $41 or so. I think this company is probably worth around $50, but $41, I thought that was actually a pretty good steal on them and a pretty good dividend yield on Morgan Stanley. JP Morgan Chase, I am up 0.76%. Not a good buy right now. I think JP Morgan Chase, company that's probably has a good valuation around less than $100. That's what I'm looking at with JP Morgan Chase, but I ended up buying them anyway. And my average cost from the last time I bought them, like I said, M1 Finance keeps your previous average cost from when you first bought the stock. So you guys will see it's like $92, which is an absolute steal for this company. And Main Street Capital, monthly dividend payer, pretty high when I bought them, but $40. Pays a monthly dividend yield, so that's interesting to see that how this portfolio can generate growth, monthly dividends, and high dividend yields all in one pie chart. So I think that's pretty significant. And I think that's it for the portfolio right now. My Roth IRA is doing very, very well, $260. It's outperforming the Robinhood portfolio in terms of percentage gain. So I know I have a lot of equity in my Robinhood portfolio, but here's our stats. Earned dividends, $60.51, $199 market gain. cash balance 193, auto vest on. So when it hits $10, it'll drip back into the portfolio and into my lowest positions, or the positions that I'm lowest on. What else do we have? So you guys can see, and that is the dividend yield currently for this portfolio, 3.29%, 32 holdings into the portfolio, and that's going to do it for the M1 Finance video, I guess. But let's talk about, actually, I did not talk about this in the previous video, in the previous Robinhood portfolio video, so I'm going to do that now. Start on Altria. I loved Altria, guys. Like I said, you guys, I probably a little bit disappointed that I let go of that stock, because I don't never try to, buy companies when they're high like that and then sell low. That's pretty much essentially what I did. But hopefully, I'm gonna just try to break this down right quick so you guys can see what actually happened and why I'm looking to buy back into Altria at a lower price. But thoughts on Altria: the cost basis that I had was $53. You guys saw that, traded with a PE ratio of 17 times earnings. To me, that goes against my rule a little bit. I like to buy around 15, of a P ratio around 15 or lower, which to me, it signifies a buying strategy that I like to do. If I can get PE ratios down to 10 or 15 or like 9 or something like that, I think those are pretty good killer buys. Those are undervalued and underappreciated stocks. Mostly, for the most part, they are. It's not always the case, but that's the PE ratio that I normally look at when I'm looking when I'm losing my words, when I'm looking at the valuation of a stock and what it's trading at. I'm looking at the PE ratio, and my cost basis was trading at 17 times earnings, which is pretty high. It goes against my buying strategy. MO dividend allowed me to exit the stock. So I had a $40 dividend and allowed me to exit the stock. I lost for MO when I sold the stock. It was around $150. But in reality, I'm only going to lose $100 from that stock. But I'm not going to get taxed on anything with that stock because I sold it. And I sold it at a loss, but will be taxed with the dividend. So I may I'm probably going to be losing a lot more money higher, probably about $10 or so. So all I really made was like $30 from that stock. But and let's continue reading here. MO dividend allowed me to exit the stock, but the 5-year chart shows a massive downtrend. So I absorbed short-term losses to buy a better growth company, Disney, trading at 15 times earnings. So Disney is still a good buy, and I had them in a Roth IRA, but I switched them over to the Robinhood portfolio and bought 10 shares of them because, like I said, if I had to pick a strategy, instead of looking at the company MO or Disney, I definitely would roll with Disney, just for that safety net. So careful reevaluation has MO at a buy at around $45 to $56 range on my list. Probably won't get that low unless the trade war and Iran move intensifies. So I've reevaluating the stock. I definitely can see that $53 may have been a bit high in this case, and I'm going to wait around $45 or so, and it's probably not going to get down to that unless the trade war goes crazy or Iran move with the whole war breaking out and the military attacking Iran and blah, blah. If that intensifies, I can definitely see stocks going lower. The stocks are at all-time highs right now, so people are just looking to sell just off any bad news that they see. So I'm definitely reevaluate my position with MO and get out of that $53 cost basis and get the stock at a little bit lower while not taking the hit. Too many moves draw from circulation from Altria stock, cannabis, cigarette sales decline, vape regulation fails, all these. Or cigarette sales decline is actually not a speculation. That's actually facts. But vape regulation fears and cannabis is still sort of iffy here. We don't know if cannabis is going to be profitable into the U.S. Right now because of the regulations. If it was like more Canada based, I can see that. And they do own Crown, but there's the vape regulation fears. There's just a lot of uncertainty right now with Altria, and if you can, I just think cost basis is everything. If you can get them around that $45 point, I think that'll be definitely a good buy with a 8% dividend yield, probably around 10% a dividend yield with a company like that. That's what I'm looking for. And you guys, I mentioned in the last video, I'm a dividend hunter. I buy when stocks are bullied and beaten down, and I thought that sometimes when you'll buy a stock and you'll be like, oh, I'm at a pretty good buy right here, and it just keeps going lower, and you have to do more careful reevaluation with the stock. So like I said, my price was definitely a little bit too high. I'm now realizing that. So, and the last thing, I had too much equity to be dependent on with MO. It represented 11% diversity, which was the highest among my individual holdings. So, it was higher than Apple. My position in Altria had an equity that was higher than Apple. It was higher than 3M. It was higher than Johnson and Johnson. It was higher than Pfizer, and that bothered me. I mean, I really was looking at that. I didn't mention it before in the previous videos, but that was really bothering me. How this stock was like the highest individual one of my highest individual holdings, and that's not something that I really want for a stock like this that's based off speculation. It's a sin stock. If I'm going to put that much equity into a company, I'd rather it be like an Amazon or an Apple or Microsoft or something like that. I would rather have a stock like AT&T. I think they're a pretty good company to put like a whole bunch of equity in. It's a much bigger company with competitive dividends. They pay a similar dividend. I think AT&T dividend is around 7% or so. Altria is around 7%. It has lower PE. I think AT&T only trades like 10 PE. It was absolutely ridiculous for a company that size. So, and then it's a cheaper valuation. AT&T is only $30. Altria is like $50 right now. So you can buy a lot of shares of AT&T and get pretty good dividends off them. Right now I'm at $50 dividends with AT&T, and with Altria, I had an equity of $3,000, and with $3,000 with only a $40 dividend. So I think that's a nice trade there. And that's pretty much breaks down why I got out of Altria. And I know I'm really disappointed because I like I said, I firmly believe in Altria. I think that right now, if you want to start a position, like I said, it's all due diligence. Look at the company, look at the metrics, see if they have any debt. But I'm doing my due diligence, and to me, I think that after reevaluation, I'm seeing MO as a buy for me personally around that $45-$46 mark. That's going to do it for the video, guys. I hope I broke down Altria. I didn't talk about it in the Robinhood portfolio in the last video, but I'm trying to get around to doing that. And you guys already saw the M1 Finance account video. I was up 31% on them. I'm going to wrap things up here, and I'll see you guys next time.